Welcome back to The Explainer. Today, we are unpacking a truly fascinating financial mystery surrounding W.R. Berkley's second quarter 2026 performance. If you love dissecting market reactions or just looking under the hood of corporate strategy, you are definitely in for a treat with this one. Right off the bat, here is the paradox we're exploring today. How does a company absolutely shatter Wall Street's expectations, achieve literal record-breaking revenues, and yet somehow watch its stock price slip in after-hours trading? Honestly, it's a classic market head-scratcher. Okay, let's dive into this. On one hand, you have these unarguable massive triumphs. W.R. Berkley delivered a huge Q2 beat. We're talking $3.72 billion in revenue, which trounced forecasts by 13.4%. Earnings per share hit $1.15, easily beating the estimates. Yet despite all of that, shares slipped 1.69% in after-hours trading, dropping down to $71.50. So what was Wall Street so cautious about? Well, to understand that, we first have to understand the DNA of this company. Before we get completely lost in the spreadsheets, we really need to ground these numbers in the human element. This quarter marked a highly poignant moment for the company following the recent passing of its founder, Bill Berkley. His defining ethos was that this business is a team sport, not an individual one. And that culture of disciplined, collective execution, that's the very foundation that allowed them to build such a resilient operational engine in the first place. And speaking of that engine, let's look at Section 1, Record Returns and Dividends. Let's just unpack the sheer financial force this company generated over the quarter. What's truly interesting here is the sheer scale of the beat. Revenue didn't just edge past estimates, it surged by over $440 million. Operating earnings per diluted share jumped a phenomenal 21% year-over-year to $1.27. And on top of that, their pre-tax net investment income hit a quarterly record of $419 million. They are quite literally firing on all cylinders. And you know what? That operational success translates directly to shareholder value. The board of directors just approved a massive 11.1% increase for their regular quarterly cash dividend, bringing it to 10 cents per share. And this brilliantly illustrates their relentless commitment to returning capital. It is not just the regular dividend increase. W.R. Berkley has maintained dividend payments for 52 consecutive years. Just think about that consistency. Add to that a newly declared 50-cent special dividend and the authorization to repurchase up to 25 million shares of common stock. All told, in just the first half of 2026 alone, they've returned approximately $558.8 million to shareholders. Which brings us to Section 2, a fragmented insurance market. So you're probably wondering, if the numbers are so stellar, why the stock drop? Well, it all comes down to market headwinds. CEO Rob Berkley provided an incredibly vivid warning. He said, Mother Nature is lulling the property market into a false sense of comfort. It's such a powerful metaphor. Management is deliberately avoiding the soft property market right now because they know that eventually catastrophe activity will return, and the industry is going to learn the hard way. They absolutely refuse to blindly chase volume in risky waters. The company is navigating a really complex landscape. They're finding highly profitable tailwinds in areas like broad casualty, accident and health, and private client personal lines. However, the headwinds are very real. Reinsurance is facing intense competitive pressure right now. In isolated pockets like habitational and liquor liability, competitors are irrationally cutting rates by 20 to 30%. Management bluntly called out this behavior for what it is: stupidity. This brings us to a vital concept for understanding their strategy: rate versus exposure. See, Wall Street gets nervous when rate increases slow down. In Q2, Berkley's rate increase was 3.8%. But remember the key difference here. Rate is about getting more price per single unit of risk. The company is actively choosing to moderate their rate increases just slightly to capture more exposure, meaning more high-quality accounts, because the underlying profit margins in those lines are already exceptional. It's disciplined cycle management, not a weakness. Another major risk they're intentionally avoiding is the managing general underwriter, or MGU model. The core issue here is delegated authority lacking in alignment of interests. When someone is paid a commission just to write a policy, rather than being rewarded for the actual underwriting profit, it incentivizes aggressive volume over quality. Berkley's management warns this trend is mushrooming across the entire industry and will ultimately end in tears. Now, moving on to Section 3, AI and operational efficiency. While maintaining strict discipline on what they actually insure, they're equally disciplined internally, maintaining an exceptional expense ratio of sub 30%. And they aren't just chasing AI headlines either. They're making highly practical investments. By implementing an AI underwriting workbench from intake straight through to quote, they're already achieving a 20+% uplift in efficiency. This allows their human underwriters to get far more at-bats and process way more high-margin business without having to increase headcount. And this tech approach applies to the claims side as well. The CEO pointed out that historically the industry has a really bad habit of using a sledgehammer when a fly swatter is really what is required. Since roughly 50% of their claims actually settle for under $5,000, they're using AI for straight-through processing. This tech acts as the perfect fly swatter, efficiently handling those small claims and delivering faster solutions for claimants, all while freeing up their human experts to handle the complex issues. So the crucial point is, all of this underwriting discipline and operational efficiency directly fuels their cash machine. In Q2 alone, they generated an incredible $800 million in operating cash flow, up from $700 million a year earlier. This massive cash flow is continually reinvested at today's higher interest rates, which is exactly what drove that record investment income we talked about earlier. Finally, let's look at Section 4, the road ahead. With all these pieces on the board, where does the company go from here? Well, analysts are projecting solid, though moderating growth. We're looking at $3.23 billion in Q3, $3.26 billion in Q4, leading to a projected full-year 2026 revenue of a staggering $12.8 billion. The growth engine is absolutely still running hot, but at a highly controlled, sustainable pace. So why does this all matter to you? Here are your key takeaways. W.R. Berkley is defined by selective premium growth, incrementally extending their investment portfolio duration to lock in those high yields, and above all, strict cycle management. Their willingness to sacrifice aggressive headline-grabbing top-line growth in order to fiercely protect their profit margins, that is the ultimate hallmark of a true long-term compounder. Which brings us to our final thought. Think back to our original paradox. The stock dipped because Wall Street often craves relentless, aggressive growth and rising rates at all costs. But W.R. Berkley? They're playing a completely different game. They are actively choosing disciplined underwriting, avoiding the market's pockets of stupidity, and prioritizing long-term margin over short-term volume. So, in a highly fragmented market, which strategy do you think wins the long game? It is a truly fascinating dynamic to watch unfold. Thank you so much for joining me for this explainer, and I'll catch you on the next one.